Welcome back to the deep dive. We've got a really concentrated stack of source material in front of us today: market trends, corporate moves, and regulatory battles, all defining the start of 2026.
That's right.
And this deep dive isn't just about the facts. It's about finding the forces moving underneath all these headlines. We're looking for where tech, finance, and geopolitics are all colliding.
Exactly. Our mission here is to cut through that noise for you, to find the essential insights. And when you put all this material together, one pattern becomes, well, pretty clear.
Which is?
We're seeing a fundamental repricing of global risk and opportunity. You see it in the chip wars, you see it in banking, even in local tax debates. By the end of this, you should really get the why behind these shifts.
Okay, so three big areas seem to be where all the friction is. First, the global competition for silicon, which is, everything in AI right now.
Absolutely.
Second, some big and kind of contradictory shifts in housing finance and federal regulation. And finally, some really high-stakes corporate fights.
From state taxes to retail bankruptcies.
Exactly. So let's start where all the growth and the conflict is living right now. The geopolitics of silicon.
Let's do it.
The AI sector is just sprinting. I mean, the pace is astonishing. We saw Taiwan Semiconductor, TSM, not only beat their Q4 estimates, but they signaled higher capital spending for 2026.
And that signal, that immediately gives everyone a confidence boost.
The whole ecosystem. It lifts peers like NVIDIA, and it tells you that the demand for AI is just incredibly robust. It's the engine.
It is the engine. And what's fascinating is how that commercial strength is immediately being, well, maybe weaponized is too strong a word, but strategically deployed.
On the geopolitical stage.
Exactly. The biggest piece of this is the new U.S.-Taiwan Chip Pact. This is not a simple handshake. We're talking about a commitment for at least $250 billion in U.S. production investment from TSMC and others.
All aimed at reshoring, building up that U.S. resilience.
That's the goal.
But $250 billion is a massive number. The real magic, though, is in the mechanism, right?
Precisely. It's not just cash. The pact links import allowances directly to building new fab capacity in the U.S.
So they're tying access to the U.S. market,
the biggest market in the world,
to physically building the cutting-edge factories on U.S. soil. It's a carrot and a stick.
A very, very big carrot.
But wait, here's the thing that feels like a contradiction. If the U.S. is giving TSMC these huge incentives to build here, why would they simultaneously enact a new 25% tariff on advanced AI chips?
Right. And they're naming names.
They're naming names. NVIDIA's H200, AMD's MI325X. Doesn't that risk upsetting the very partners you're trying to bring in?
That is the key question. And it shows you what a complex balancing act this is. The administration isn't trying to punish Taiwan. It's a surgical strike.
Aimed at what exactly?
Aimed at ensuring that the most advanced chips, the ones that can train the biggest AI models, are either made here under this new pact or they're used for very specific approved applications.
So the exemptions are key.
The exemptions are everything. They're carved out for chips used in U.S. supply chains and approved sales. It's about protecting the domestic tech they're investing billions in and maybe fencing off other global players from getting their hands on that same high-end tech.
A strategic decoupling.
Where it matters most, yes.
Okay, so the semi-world is hot. The rules are being rewritten as we speak. Let's shift gears a bit to the broader financial picture, because there's some really good news for homeowners in this stack.
Absolutely. The biggest positive for consumers was the drop in borrowing costs. The average 30-year fixed mortgage rate hit a 3-year low.
What was the number?
It settled at 6.06%.
Wow. That is a huge psychological shift for the housing market. That kind of drop immediately lifts purchase and refinancing activity. It just injects a bit of life back into the system.
And if you're a lender like, say, rocket companies, you're positioned to benefit from that volume immediately.
Right. But while housing got some good news, the picture for the big banks was much more mixed.
Very mixed. You had Bank of America topping expectations, solid, but then Wells Fargo missed, and Citigroup was just a mixed bag. It tells you there's still a lot of pressure out there.
But the real star, at least in investment banking, was Goldman Sachs. They topped profit views with a Q4 EPS of $14.01.
And the interesting thing there is why. Goldman's strength was overwhelmingly from its equities and fixed income trading desks.
So the institutional side is thriving in the volatility.
Exactly. While the banks that are more reliant on, the average consumer or Main Street lending are still feeling the pressure. And Goldman did this even while they were exiting the Apple Card portfolio.
Okay, now let's get into the political headwinds, because this gets messy. The stack detailed a DOJ investigation into Fed Chair Jerome Powell.
And that kind of news, it just instantly creates friction, uncertainty.
I can imagine.
It drew immediate and bipartisan criticism. The real concern, regardless of the probe substance, was about the independence of the Federal Reserve.
That's a bedrock principle of modern finance.
It is. And it was notable how quickly the White House distanced itself from the probe. They were clearly trying to contain any perception of political interference.
And speaking of uncertainty, the crypto space is still waiting.
Still waiting. Yes, the Senate postponed the markup on the digital asset market structure bill. That just tells you there are still fundamental disagreements on how to regulate this stuff.
And for firms like Coinbase, that just creates a headwind.
A major headwind. They thrive on regulatory clarity so they can bring in institutional money. Without it, you're just kind of stuck.
Let's use that as a bridge. We're moving from federal oversight down to some really intense domestic pressures. Let's talk about the corporate battles, starting in California with that proposed one-time 5% billionaire wealth tax.
This is a huge test case, not just for California, but for the whole country. And you're seeing wildly different responses from corporate leaders.
Like who?
Well, you have NVIDIA CEO Jensen Huang, who publicly voiced, sort of, indifference, said it wouldn't change the company's plans. But then you have leaders connected to Alphabet, Oracle, Palantir, and they are reportedly weighing either moving out of the state or fighting this thing tooth and nail.
And according to the sources, their best weapon isn't just threatening to leave. It's a legal challenge.
Exactly. The lawyers are focusing on one critical detail, the retroactive date of the proposal.
Why is that so important?
Because retroactive taxes face huge constitutional hurdles. It raises all sorts of questions about due process. If they can get that retroactive part struck down, the whole measure might just fall apart.
Fascinating. Okay, shifting from state taxes to retail drama. Amazon is challenging Saks' bankruptcy plan.
And they are coming in hot. Amazon claims its $475 million equity stake from the Neiman Marcus deal is now, quote, presumptively worthless.
So this is a fight over who gets paid first in the bankruptcy.
That's exactly what it is. And Amazon is firing a warning shot, saying it might seek an examiner to look at the retailer's financing, specifically the $1.75 billion in DIP funding.
Okay, let's unpack that for a second. What's the significance of challenging the DIP funding?
So DIP debtor in possession funding is basically new money that keeps a bankrupt company running. The key thing for you to understand is that DIP debt usually gets paid back first.
Ahead of everyone else.
Ahead of almost everyone, certainly ahead of existing shareholders like Amazon. So Amazon is basically arguing that this whole reorganization is rigged to protect the new lenders at the expense of old shareholders. It's a very aggressive move.
And while these corporate giants are fighting over billions, consumers are feeling the pinch in other ways.
We're definitely seeing it with subscriptions. Spotify is raising its U.S. premium price to $12.99 a month.
And other plans are going up too.
Right. They're saying it's for product investment, but it's a clear move to raise their average revenue per user.
And on the flip side, when a service fails, companies are paying up.
A little bit, yeah. After that huge nationwide outage, Verizon issued a $20 account credit to customers who were affected.
$20. It's a small gesture, but I guess it's a necessary one.
You have to do something to manage the customer relationship, especially when people feel like they can switch carriers easily.
Okay, let's turn our attention now completely to the future, starting with a really provocative idea from Elon Musk. He predicted that AI-driven abundance would make retirement saving irrelevant.
It's a huge claim, and it forces you to question some really fundamental assumptions about, personal finance.
He's basically arguing that AI will make the cost of everything so low that you won't need a nest egg.
That's the argument. But the sources provided the essential counterpoint, the grounded take. Academics and finance experts are strongly cautioning that households should absolutely keep saving.
Because we're not there yet.
We are not in that AI utopia yet, and the timeline for this abundance is wildly uncertain. So it's a fun thought experiment, but it's terrible financial advice for today.
Right. Stepping back into today's reality, we saw a lot of high-value action in healthcare and energy.
The JP Morgan Healthcare Conference really set the tone for the year. The big themes were AI and diagnostics and R&D, regulatory uncertainty, and just constant cost pressures.
And we saw a major M&A deal that shows where the smart money is going.
We did. Boston Scientific, BSX, is buying Penumbra for about $14.5 billion. This is a huge strategic move.
Why the number?
It expands Boston Scientific's footprint into mechanical thrombectomy and neurovascular markets. We're talking about high-growth, life-saving procedures for things like strokes. It's a big push into specialty, high-value medical devices.
And over in the energy sector, a big win for renewables.
The very big win. A federal judge cleared the Revolution Wind project to resume construction. And what's more, Dominion Energy's project in Virginia was cited as being critical to future grid reliability.
So these massive offshore wind projects are no longer just, environmental nice-to-haves. They're essential infrastructure.
That's the key shift. They are now seen as essential for grid stability.
Let's also touch on some changing consumer habits that could be a leading indicator. Specifically, the rise of prediction markets.
This is really interesting. The data shows prediction markets like Kalshi and Polymarket are drawing in a much younger crowd. We're talking 18 to 20-year-olds.
And that's influencing sports betting.
Analysts think so. It's creating this adjacent, really sophisticated market that companies like DraftKings have to pay attention to. It's a whole new way a generation is monetizing knowledge.
And just to end this section on a lighter note, Honda debuted something that feels very tapped into the current moment.
The base station camper prototype. It's lightweight, designed to be towed by compact SUVs or even EVs.
With modular options like a pop top and an external kitchen.
It just speaks directly to that desire for mobility and flexibility, but it also acknowledges the real-world constraints of an electric future, like towing capacity.
So if we pull all these threads together, from microchips to mortgages to campers, what's the central takeaway for you?
The dominant thread is the impact of AI and geopolitics. Those two forces are fueling this great repricing of risk we talked about at the top.
And it's restructuring everything.
Everything, from chip supply chains with the TSM Pact to the very philosophy of how you should think about retirement. We're just in a new environment where global strategy and rapid tech disruption are the baseline.
It definitely requires a long-term view. And before we wrap, I want to leave you with one final thought on that, something to mull over. We look at these huge industries, but sometimes the smallest ones tell the clearest story.
Go on.
The Silicon Valley Bank Wine Report, it projects that demand in the U.S. wine industry won't bottom out until 2027 or 2028.
And the sources noted that the premium wines are doing better than the cheap sub-$12 bottles. It shows a real split in consumer spending.
Exactly. But think about that timeline. A slow-motion recovery in a niche industry like wine, which needs years to clear out its inventory. What does that tell you about the patience required for investing in any sector that's navigating a similar overhang right now?
It suggests that looking past the next quarter toward a multi-year recovery is maybe the most important asset an investor can have.
Perhaps the most undervalued asset of all. Think about that the next time you look at a stock chart.
A powerful point to end on. Thanks for joining us for the deep dive.
We'll catch you next time.